Welcome, everyone. We're going to get started here. So just a little background. My name is Seth Glasser. I'm joined by my partners at the New York Multifamily Group, Koicim and Shaun Riney. We sell about 100 apartment buildings every year throughout New York, and we're the only geographically integrated sales team in the city. And we connect capital and investors between Manhattan, Brooklyn, Queens, and the Bronx. So we wanted to start with giving everyone a little bit of perspective on and insight on some of the things that we've noticed on a daily basis in some of our conversations, but also looking back at more of like a macro perspective on our industry, the market, and the economy as a whole. So the last 4 years have been interesting, to say the least. It's been a very turbulent time. So obviously everyone knows in 2019, the rent laws changed and fundamentally flipped our business on its head. And then in 2020, we had COVID, and that resulted in a couple of different things depending on the market. So the free market apartments in the city, we saw the immediate effect. The rents went down precipitously, often by 30%. We had this huge vacancy issue. And then in the secondary and tertiary stabilized markets, we noticed a big collections issue. And then in 2021, we had a new economy. We seemed to be rebounding, but we were also challenged with ERAP collections and the housing court backlog. And then in 2022, everything seems to be going great in the beginning of the year. And then we've been confronted with massive inflation. And as a result, the Federal Reserve has been combating that very aggressively with rising interest rates at a pace that we haven't seen before. The business, from the early 90s, the rent laws changed more favorably for landlords, where they were able to raise the rents with IAIs. And that was basically one long cycle. For 20, 25 years, up until 2019, the wind was at the landlord's back. So you had rates generally declining for 25 years. You had the city gentrifying and the market rents increasing. You had very favorable RGB increases, and you had 15 and 20% vacancy turnover. So for 25 years, that was all, it was all good, really. And then in 2019 until now, every single one of these things is the opposite. So our point here is that many people have been in the industry for a long time and have done business one way. And since 2019, our point here is that the way that the business has to be done is now fundamentally different. So if you're not adapting and changing your practices, you might get left behind and you might find yourself stuck. So said another way, what you've done to get you to where you are today is not necessarily the same thing that you're going to have to do to get you from where you are today to where you want to go. So I think this is interesting. In 2009, that was the heat of the Great Recession versus where we are today. This is the 10-year Treasury. The 10-year Treasury today is actually higher than what it was in 2009 in the recession, and it's trending up. And in 2009, it was trending down. So there are several similarities, and there's also a couple of differences, and I'll point these out to everyone here. In 2009, the one-year RGB increases were 4.5%, and this year they're 3.25%. In 2009, it was very difficult to get a loan, and now today it's, I would say, similar, but really only the bigger players are able to get the financing through the relationship lenders that they have. In 2009, the Dow was at 10,000, so there was no equity, no liquidity. Today, it's at 30,000. In 2009, the vacancy increases were 15 and 20%, and today there are no vacancy increases. The IAIs were 1/40th, and today they're 1/180th, but they're only capped at $15,000. So there's several similarities. I think that everyone should digest that information when they think about their businesses today and moving forward and what they project will happen to our market. So the moral here is that the world is changing very quickly and it will continue to change fast. So the goals for today, we're going to dive in with Shaun and Joe about the New York City market update. We're going to talk about some of the things that are selling and some of the challenges that we've been having over the last few months. Jay and Christina are going to talk about their court case and HSPTA and the new DHCR bill that was proposed in September, and a good cause eviction, and some of the nuances in the political landscape that have been happening, and how apropos to have this webinar today. We had the debate last night. So I'm joined, like I said, by my partners, Joe and Shaun. Jay Martin is the executive director of CHIP. For those of you who don't know, CHIP is the largest landlord advocacy group in New York. They've done a phenomenal job of helping our industry. And Jay is actually, he has a very interesting background. He's not in the operations or management or ownership business. He actually has a 20-year history in the political landscape. So he brings a very unique perspective to our industry to help lobby on our behalf. And of course, Christina Smyth, she was recently appointed by Eric Adams as one of the new RGB members. So congratulations again to her. She's a landlord attorney representative, and she does a lot of DHCR work. And so she's been instrumental to helping a lot of our clients. So we're going to start off, Shaun and Joe are going to talk a little bit about some of the deals, what's selling, what is not, who's buying, who's selling, and the lending environment. So Joe, I'm going to start off with you. Why don't you tell us a little bit about these deals?
Sure. We thought it'd be a great idea for everyone to just see some recent deal stories and some on markets. So these two properties were in the East Village that we recently sold, 100% market rate, sold as interest rates were rising. And everyone wants to know who the sellers are today and who's buying. The seller here decided to sell in this environment because his alternative was not good. His alternative was putting more cash in the deal in a cash in refinance situation. And then, you know, there's other groups that are still very bullish in New York that are coming into the market. The buyer of East 4th Street between C and D is a new buyer that's raising capital from overseas, mainly Germany. And the Second Avenue buyer happened to be a buyer in an exchange from LA that owns some properties here in New York. And as you can see by the price per pound, it was aggressive at $1,500 a foot, but it was in place cash flow. So everyone wants to know, how do I buy a property today if rates are continuing rising? But you know, rents are still rising. So, and we're seeing that across the board, especially downtown Manhattan.
Yeah, there's definitely been a flight to quality.
And speaking of flight to quality, this is a portfolio that we're just about to launch downtown. It's in the Village, Greenwich Village and East Village, 7 properties, 130 units. We're asking just around $800 a foot at an asking price of 5.2. These are in prime locations, you know, mostly Greenwich Village, McDougal, Sullivan Street. And we're selling this portfolio for a large multifamily owner. And a lot of the reasons he's decided to sell now, he's owned it for 10 plus years, and he's diversifying and reallocating the capital to investments across the country and mostly red states. So he's not giving up in New York. He still owns a lot in New York, but he's just decided to diversify his portfolio and starting with some of these assets.
Right. So what we've noticed, Joe, maybe said another way, is that people who have opportunities and capabilities in other parts of the country, whether that's multifamily or other industries like hotels or net leases or whatnot, are choosing to take their equity. They feel like they've taken it as far as they can go on some of these assets in New York and are allocating it into other markets where they feel like they can grow.
Yeah, we're seeing that. Yeah, and we're seeing that across, you know, many owners in New York City. You know, obviously a lot has to do with the political landscape that Jay is going to speak about and what's happening, and just kind of taking some chips off the table and diversifying into other asset classes, other markets, maybe more favorable red states. And that's something we've seen, you know, recently, even despite the rising rates of what's happening in, you know, today's market.
Right. Well, I think actually part of it actually has to do with the rising rates, right? If this owner or someone similar has debt from a few years ago at 3 or even 4%, and they're looking at a refinance over the next 18 months, potentially at 6%, what we've noticed is people are making their decisions proactively, by looking into the future and really having an honest conversation with what they want to do with their business moving forward.
That is correct.
Yeah, I
Shaun,
think-
tell us a little bit about this deal on 4th Street.
I think that's accurate. And just to say one thing I love about this business is there's no insider trading in real estate. You know, you're not going to jail. This is all information business. And especially at times like this, you know, really want to be thankful for the panel and just encourage people to reach out on a direct basis because information is everything. And, you know, that's the key to the kingdom here. This, you know, just to parallel off what Joe said, how do buyers reconcile buying in today's environment? I think just the thesis behind that is to take 2 years interest only, which the banks are usually offering in exchange for putting significant deposits down. So for the right deals, I'm okay putting 50% down payment down, and I'll get by on the first 2 years with an IO period. And that seems to be the general thesis for the right assets that buyers are using to justify buying, you know, basically a, you know, 5.5 cap and a 5.5% interest rate environment, or basically with no real spread. On the anticipation that in 2024, 2025, there'll be some type of QE that encounters the marketplace. Seller profile here, I think this is one of the better offerings that I have on the table. It'll probably get wrapped up in the next few weeks, but 6.3% cap rate. The seller, like Joe mentioned, is somebody that executed a value add business plan and refinanced a few years ago, but is now, you know, about a year out from the next maturity and has to decide whether to, you know, pay back down the loan with some of the money that was already returned to investors or sell. And right now the decision is to sell, but quality asset at a 6.3% cap rate with 40% rent stabilized units. The buyer pool is a little bit opaque because right now there's not a tremendous amount of capital that is earmarked for hybrid, half rent stabilized, half free market properties. And that is the opportunity. So that's the profile here. I think this is a great opportunity to look where others aren't.
Yeah, I think this is what we've noticed over the last, I would say 18 months, giving the building an identity. So what is it? Is it almost all free market where you don't have a lot of regulatory issues, or is it almost all rent stabilized where your price per foot and your basis is really attractive in a good location? So a 60-40 split, who's the buyer? So that, I think, is what Shaun is saying, and that's probably the greatest opportunity. You're asking a 6.3 cap for a building in a great location, and comparably, that's 100 basis points better than something in Manhattan. So I love the opportunity, Shaun.
And just to contrast that, here's a 32 unit. We just went from a 31 unit because of the stabilization portion and a little bit of inferior location at a 6.3 cap to something that's in contract, same unit count at a 4.5 cap. So almost a 200 basis point spread because it's 81% free market in a slightly better location. So that's just one contrast I wanted to point out. And the other thing that's notable, buyer here is also backed by European money. And for the right quality inventory on a corner, 1 block from Prospect Park, you do still see trades at cap rates below the cost of debt. They're a little bit trickier to sell now than they were 3 months ago, but the right upside profile can still trade at cap rates under the prevailing cost of interest rates.
Interesting. This similar type of situation here. This is a 93 unit apartment building in Marble Hill overlooking Inwood and overlooking the water here. We're selling this for a family that's owned it for 50 years. A third of the apartments are deregulated with an average rent of about $1,400, and the other 2/3 of the building have preferential rent. So you can buy this day one slightly over a 5% cap rate. And if the only thing that you did was re-rent the free market apartments to Section 8 tenants at the Section 8 rents, you would take the free market rents from about $1,400 to $2,100. So you can go within 18 months and build to north of a 7 cap, and you still have 2/3 of the building on preferential rent. So this is getting a lot of interest. We anticipate a contract getting signed in the next week. Contrary to that, this has been actually very challenging to sell. These are elevator buildings on Broadway in Washington Heights. The owners of these buildings, the owner of these buildings spent about $2 million on each of these in the last couple of years on facade work and elevators and IAIs. And to my point earlier, they lack identity. And again, what I mean by that is 25% of the units are free market, 30% of the income comes from retail, the rest of the apartments are stabilized. So we're not selling it at a very high cap rate, and we're not selling it at a very low basis because of the heavy retail component. Our price per unit and our price per foot are very high. So $250,000 a unit, $300 a square foot. Your basis buyers in the market can't conceptualize that. So they rather go buy something like this at $130,000 an apartment, even though the cap rate on these buildings are over 100 basis points better. So these buildings, these used to sell for 15 and 16 times the rent roll. These are going to sell for 8.5 times the rent roll. Elevator buildings on Broadway in Washington Heights, 8.5 times the rent roll. Okay, without further ado, the main event, Jay, Christina, welcome. Thank you very much for joining us. Jay, I want to start with you. Tell us a little bit about how you have been spending your time with Chip.
Thanks, appreciate it. Great, happy to be here. I also appreciate Marcus and Millichap. You guys always do an excellent job of giving your clients the full picture of what's going on in the market. So always good to work with you guys. So I'm Jay Martin, Executive Director of CHIP. We have been working on a number of fronts politically to protect the industry, specifically the rent stabilized industry, from various bad pieces of legislation. I thought it was interesting to hear a little bit about capital flight going to states with better political environments, described as red states. New York, as you would know, is described as a very deep, deep blue state. But I think there are like little spring shoots of potential promising developments, I think, in our battle for property rights and the ability to make a living on rent stabilized properties and rent controlled properties. So number one is that we, almost 2 years ago now, we developed a lawsuit against the current rent stabilization regime on three simple premises of takings, an applied taking, a general taking argument, regulatory taking argument. And the general context of the lawsuit is nothing new to anyone who's tried to operate rent stabilized housing in New York. But the general context is the update where we are is the Second Circuit. We're waiting for a decision any week now on our arguments. And from that period, it would be an appeal to get cert in front of the Supreme Court of the United States. We're hopeful, if we're able to get that argument, that the Supreme Court would rule that the rent stabilization system as it exists in New York is unconstitutional. And it's very simple. The argument is simple. It boils down to the government has every right and ability to regulate housing, but they can't do it in a way that doesn't provide fair compensation to property owners. And there are many incidences, as those of you who own and operate rent stabilized housing, where the fair compensation part is where the takings comes in from the government's perspective and from our perspective as property owners. So we're hopeful that our challenge will be successful. I don't like to put odds on anything, but I will say it's always, and Christina being our expert legal analysis on the panel here, can tell you how difficult it is to get in front of the Supreme Court. They only take about 150 cases nationally of thousands that they're heard on every year. But I will say, even if our case, and I will say this, forward thinking, even if our case isn't successful, and I believe it will be, there are many specific legal challenges to be made against the HSTPA as it currently exists. It is a vulnerable law for legal challenge. One in particular, and best and possible outcomes, I'm skipping a little bit to the vacancy reset, is the ability for an owner and the way the government is currently regulating vacancies. So New York is unique nationally in that it is the only city or state in the entire country, not even San Francisco, not even California, that the government regulates a vacancy of an apartment. And that's key because the issue there is the government is essentially saying when a tenant vacates, that they have the ability to control that unit of private housing after the lease ends and when the new lease begins. What we've seen after, as Seth alluded to, when the vacancy bonus was taken away in 2019, and when the ability to deregulate units where it was removed, we're now seeing post-COVID tens of thousands of units of housing with operating rents well below their operating income necessary to maintain the units, and in need of tens of thousands of dollars in renovation costs, stay vacant because property owners first can't borrow against those unfunded rent rolls, we're calling them, on those units with below market rents. And two, because the 30-year, as Seth said, 1/80th ability for $15,000 over 30 years doesn't even remotely come close to covering the entire renovation cost. So it's actually cheaper for an owner in this nonsensical policy to keep a unit of housing vacant. They save more money by keeping, and some of you have experienced this, the housing vacant and unrenovated than they do renovating it and putting it back on market at the current rents. So the benefit of our policy proposal, which is a vacancy reset, which would allow an owner the ability of long-term vacancy to reset the rent to market. It would still be regulated, but it would be reset to a rent that the property owner could then fully be compensated for the renovation costs of putting it back on the market. And by the way, reset the rent to a more realistic rent. These rents are essentially, it's good to think of them as basically locked in to the same rents they were when the first tenant took occupancy. So we're looking at rents from the 70s, from the early 80s, of folks who essentially got that deal, stayed in their apartments for 20 or 30 years, and those rents only went up by the RGB increases over that time. So they're on average 30 to 40% below where they should be. So allowing for owners to do a vacancy reset will put units back on the market. The benefit of all this is it costs the government nothing. It increases tax revenue to the municipalities. It doesn't raise the rent on any current tenant because remember, these are unoccupied units of housing anyway. It adds for revenue generation and value creation for the properties themselves, for potential owners and current owners. And it has the benefit of actually being good housing policy because this city and state needs more housing, and it continues putting that churn of unavailable below market apartments that need significant renovations back on the market. It's a win-win. Sorry.
No, Jay, sorry, I was going to ask you, is the vacancy reset, is there a way to separate that from the court case with HSTPA? Like, can we have one but not the other? I guess Christina, feel free to chime in here around, some of the other. Like, are all of these treated in separate silos, or is there a scenario here where vacancy reset, good cause eviction, HSTPA, like, is there some type of compromise here where we end up with, it goes in black and white and comes out gray?
There's a lot of potential. Yeah, a lot of potential for different outcomes. The response has been for our proposal in a vacancy reset is from the legislators currently has been that owners should continue to lose money on these units, renovate them at loss, and put them back on the market because many elected officials in this city believe that they are in the business of providing free housing and non-for-profit housing, even though they need to make a living and an income to be able to keep sustaining these rent stabilized properties.
Yeah, I saw there was a recent article in, what was it, the City Journal that came out maybe 2 weeks ago that there's now 60,000 vacant apartments. And I think a month or two before it was 40, and then a few months before that it was 20. So it seems like every time someone does a survey, the number goes up.
Yeah, well, the issue there is HPD doesn't HPD defines vacancy as a floating term. There at any given time, there's always tens of thousands of vacant units of rent stabilized housing. There's a churn that happens, lease between lease. So at any given time, there's about 15 to 20,000. We believe that there's closer to 40,000 permanently vacant units currently. So that 60,000 number, that 80,000 number that were being reported by the city, we believe was inaccurate. HPD has contradicted their own numbers in that reporting. So we think that the number of truly vacant units is 40, but it is growing. It's 40,000, but it is growing. So it is a need, it is a fix that must be taking place because, as we know, it's a cancer that will continue to grow in these rent stabilized properties until it is fixed. And the law, by the way, was intended to do this. It was intended to reduce any ability for a property owner to deregulate, to have any incentive to get long-term tenants out of the units, and under the delusion that a renter would only want the cheapest rent possible and not the best, most affordable, safe housing as possible. It's placating to a voting constituency instead of placating to the best housing policy. I think we have had great conversations with lawmakers so far. I think we're going to introduce a bill in January that's going to have sponsorship. Will it pass this session? I don't know. It's always difficult to get a bill in Albany passed, especially the first year you introduce it, especially in this political environment. But a lot of will be determined over the next 2 weeks in the election. Interesting.
Okay, Christina, I want you to chime in here because I feel like you're very much in touch with the political environment, and Jay sort of opened the door here for you. And of course, we had the debate last night. So what's your sense right now of the political environment, right? You know, we have a new mayor. Are we turning a corner?
Yeah. Well, I think that there's a lot for us to work with as a community. I think we have all, you know, every owner on the call has been, and their representatives, myself, Jay, we've experienced the punitive nature of New York State government, New York City government, from HPD to DOB to the legislature. And the figure that I read this morning is that our community is 54% of the real estate taxes are 54% of the total tax collection. You know, real estate related taxes make $35 billion worth of the 2023 budget coming up for New York City, with all other sources of tax revenue making 30 billion. So, you know, I've always said that the real estate community and the contribution that we make to New York City, we should be worthy of more favorable, more amicable laws. And the last several years have been quite punitive in nature. But I'm an optimist, and you know, I think that the word is getting out amongst legislators that owners are not desirous of keeping units vacant. That's not what we're all here to do. We want these units to get back on the market. We need to, just like I did on the RGB, you know, we need to get these units renovated, and we just simply cannot do it without a fair rent once they come back online. I was happy to achieve with the rest of my board members, some more helpful than others, but we on the Rent Guidelines Board achieved the highest rate that the city has seen in 6 years. And it's still woefully insufficient. Jay tells me all the time, you know, thanks for the 3.25 and 5%, but there's so much more to go, and the expenses just keep coming in. I did want to highlight that the DHCR just put out its reasonable cost schedule, it's online on the DHCR website. And the DHCR has a boiler at $207,000, a new apartment door at $1,700. You know, the list goes on and on. These are, you know, converting to electric, which is what the city is soon to be mandating. All of these things have tremendous expense. I don't need to tell the owners on this call about what things cost, but we're starting to see more and more that there is some receptivity to the fact that owners, multifamily owners, we're providing the most populous city with housing, and we need to be treated much more fairly.
Yeah, interesting. There was prior to Adams getting elected, the last mayoral election, there's 8 million people in New York City who are, I guess, eligible to vote, and only when de Blasio got elected, only 800,000 people voted. So only 10% of the population in the city voted. So, and then that went up, I think, to about 1 million when Adams came out. So look, it's the proof is in the pudding. We all have to show up and vote to support our industry here. Christina and Jay, you guys can talk about this, I guess, together. You know, one of you guys can take this, but the legislative session opens, I believe, in January, right? Christina, correct me if I'm wrong here. What do you foresee is on the table here?
Well, a couple things. So, you know, the elephant in the room is good cause eviction. It's been being pushed now since 2019. It was actually part of the original 2019 rent laws, and they didn't have the political capital to get it done with the rent law changes. But so they've broken it apart separately, and they've been pushing it for it. You know, everybody always asks me this question: what are the odds? Is it going to pass this session? Where are we at with it? Look, I think it's really important to keep an eye on where the world is, right? So, and lawmakers are not unlike human beings. They, believe it or not, they actually are. I find it hard to believe myself. So, you know, when they read the news and they see articles that are saying that the rent is constantly going up and up and up, or they hear brokers talking about the rent going up and up and up, they react to that. And at the same time, they react to the inverse news, right? So there was articles in the last 24 to 48 hours that rents in nationally and also in New York could be leveling off. That's actually good for our efforts to prevent good cause from passing. Maybe not so great for selling apartment buildings, but the long term here is it is good for selling apartment buildings, because it actually makes it harder for them in their narrative to push good cause eviction, which would regulate, for those of you who don't know, in 2 seconds, good cause eviction would be a universal rent control bill across every 4-unit or larger apartment building in the entire state, would be regulated at currently 1.5 times CPI or 3%, meaning every increase in rent year over year couldn't be higher than those two numbers. Now, CPI has been high, obviously. It's also was helpful in us getting that rent increase that Christina was so instrumental in getting, because inflationary costs have been so high. But when CPI isn't high, it would have been about 12% this past year, based on the law's proposal. It would be closer to 3%. And that is just not a realistic rent increase number year over year for property owners to deal with increasing property taxes, water, sewer, different mandates coming down from the city and state at all times, local law 97 in the city. So that proposal, I believe, is going to have an extremely difficult time, not only this session, this is good cause again. So good cause passing this session, I think, will be unlikely. I think they're going to try. I think they are going to push. I think the perception is going to be collectively from our industry that it is a threat, and it is a threat that we must fight. But I think right now, depending on how the election shakes loose, the Democrats are going to lose some seats in the Senate. The Republicans are going to pick up some seats in the Senate. They're not going to win the majority. The Democrats are going to lose some seats in the assembly. They're going to maintain a Senate assembly supermajority, and the congressional race. The gubernatorial race. The gubernatorial race will dictate significantly the direction of good cause next session. If Lee Zeldin were to somehow win, and I think that I will say in my political opinion, no benefits aside, whether or not it would be good or bad for real estate, it certainly would probably be better. If Lee Zeldin were to win, it would virtually assure good cause does not pass this session or in the next 4 years. If Kathy Hochul were to win, there has been an indication in conversations we've had with her staff that she doesn't support the current version of the bill. We've also talked to about 22 state senators, a collective mass who will not support this current version of the bill. So all those things being considered, we believe that good cause has a very difficult path to pass as this current version.
So Jay, let me ask you, if this gets brought to a vote and it gets struck down, does it just go away forever, or in theory, could it come back again in another form?
Well, that's an excellent question, actually. To your going back to our constitutional challenge against the rent stabilization law, and even the best case scenario, if we were to win and strike down this current version of the HSPTA, the legislature will write a new law. And our hope is that our lawsuit, and if we were to have to your question, do a legal action against good cause if it were to pass, it is not necessarily to win the right to prevent them from ever having the ability to regulate our units, because we believe that they do have that right in the Constitution. What they don't have the right to do is not compensate us fairly. And the good cause bill as proposed does not provide fair compensation. And the current HSTPA regime as operated doesn't provide fair compensation. So we would expect a new form of rent regulation, more closely similar to other models. I've heard California as an example, which has a 5%. It started at a 10%, it has a 5% national cap or statewide cap. It also allows for a vacancy reset. In other words, an owner has control of their unit once the person vacates. It's actually private property. So all of those things could play out. There's a plethora of scenarios that could happen.
Is there, I kind of asked you this before, and it's a tricky question, obviously, but is there any scenario early next year in the legislative session that the good cause eviction, HSTPA, and the new DHCR bill eliminating Frankensteining or the combining of units is there any sort of horse trading that can allow for some type of loosening for our industry, or are they completely separate issues attached to completely separate decision makers?
Good questions. Good questions. Yes and no, and I'll actually tee up the DHCR bill because we didn't get to talk about it, but it is fascinating from a property rights perspective. So the DHCR bill is not actually a bill. It's regulations being promulgated through DHCR that would redefine an owner's legal ability to combine units, what they're calling Frankenstein and what we're calling right-sizing housing for the market, and an owner's private property. But these proposals are coming directly from DHCR. The issue with that is that it's not voted on by lawmakers. It is a regulatory rules change. We're in the 30-day comment period now. There will be a hearing in November for this. Public opinion is welcome. And I would encourage our members and all those on the call to testify or submit testimony against the proposal. But Christina can tell you how the bill would drastically change the ability for an owner to combine 2 units or change the footprint of 2 units. But we think that that proposal is separate from good cause and the other. There is a world or a scenario here where DHCR could change their own rules. It's been done many times. So DHCR rules should be looked at, I think, separately from HSTPA and good cause.
Yeah, just a quick note on the DHCR code they're calling it a code revision. And essentially they're allowing themselves to do it as an extension of what did not get taken care of in HSTPA or covered, so to speak. So where HSTPA locked out an owner's ability to deregulate housing and achieve rent increases, there were two avenues that remained. To achieve a fully fair market building, you could substantially rehabilitate the building. That's a legal term. That's a DHCR term. And change 14 out of 17 building systems, and then you would achieve a completely free market building. There's lots of other components to the substantial rehabilitation law, and I won't bore everyone with that, but this new code revision, proposed code revision, is coming for substantial rehabilitation in some ways, and then also the only other way that you could achieve a market rate stabilized rent, right, would be to combine units. You could take a 500-foot studio apartment that was stabilized, and you could combine it with a 1,000-foot stabilized or fair market unit. And the result would be a 1,500-foot new unit with an owner's ability to set a first rent. So the rent would match the market, and you would go on, and it would be a rent stabilized lease. That is what the legislators like to call a loophole. There's no one on this call who would go around and say that it was a loophole. It was certainly just more a business decision. If you had an underperforming studio next to an underperforming one bedroom, you could make a new unit and set a first rent. So those are the two things that are sort of on the table at this 11:15 public hearing, and anyone's guess. As far as horse trading goes, I mean, Jay, with his 15 years experience in Albany, certainly knows that that is one way that things get done. It's one of the ways that HSTPA happened on the eve of the closure of the 2019 legislative session. So, Jay can speak more to that. The DHCR, though, is two separate buckets. What's happening this November, December on the combo units and sub rehab is very different than what's happening in Albany. Related, but sort of separate buckets.
Okay, interesting. And we're going to get to some questions in a minute, guys. Everyone remember that at the bottom of your Zoom link, you can type some questions in, only viewable to the panelists, and we'll address those in a second. But this is all very interesting. I think from the broker's perspective, in terms of being able to sell these apartment buildings, what makes it very challenging is the unknown, right? HSTPA is in the rear view mirror. It's set in, I don't want to say stone, but hopefully erasable marker. But the DHCR bill and good cause eviction is just out there in the universe, and buyers are having a hard time knowing what to do. Will it get passed? Will it not get passed? The constant moving of the diligence requirements, right? That was what, we see this so often where when we have an accepted offer on a property, the buyer and the seller are happy, and we're negotiating a contract, but the buyer's like, okay, now I need to go look at your files. And this is, really where the rubber meets the road here, and where people like Christina have been extraordinarily helpful. The diligence environment is just so challenging right now. So I don't know, Christina, is there anything that you can touch on in this respect?
For sure, it's a great question. Different buyers do different levels of diligence. My firm handles, I would say, 65-70% of my practice is pre-purchase diligence. We do it on behalf of sellers and on behalf of buyers. Oftentimes, long-term clients say to me, I'm about to take this building to market. I want to make sure it's in the best condition, regulatory condition that it can be. And so we'll do a DHCR audit. And, you know, I have lots of opinions on the IAI system. That's the individual apartment improvement system, which was in place, as you said earlier, Seth, for decades in various forms. The IAI system that was run by DHCR could have been pure magic, in my opinion. If the DHCR had set up a portal 20 years ago and said, upload all your renovation documents, we will say, yes, the apartment's deregulated. No, the apartment is not deregulated. This is what we need. And instead, now, 20 years later, they've taken IAI off the table completely. And we are all subject to these very costly, extensive audits of individual apartment improvements. And this is all part of the pre-purchase diligence, the pre-sale diligence. Those records need to be impeccable. And what I tell my clients in a diligence is, my goal in the diligence is to make sure that, heaven forbid, you get a challenge after you own these bricks, that you will prevail on a rent overcharge claim or a TPU audit. And that's sort of the lens with which my firm looks at it, you know, making sure that all the contractor records are in place, the council checks, the contractor affidavits, and that the rent roll that you're selling or buying is lawful. And, you know, unfortunately, listen, I love to practice law, but it really is onerous on owners, buyers, and sellers to have to go through 15 years of records just to make sure that a rent roll can be sustained on a challenge.
Yeah, you should. So we have so many funny stories of people sharing with us where they keep their records. I mean, everything.
Oh, yeah.
Like the basement of the building to their summer house to the back of their van, you know, whatever. So it's just,
Yeah.
It's an interesting, challenging time, but I want to open it up now. Joe, a few people have asked some questions. Do you want to bring these out here for the panelists to answer?
Sure. Before we just jump into that, though, as far as where people keep their records, and, you know, back in the day, Christina, you know, owners were allowed to throw out their records and didn't need their records.
Yeah.
So how do you advise those clients moving forward in getting prepared if they do bring a property to market, and how is it sellable?
Yeah, I mean, there was a law that you had to retain records for 7 years, and lots of owners relied on that. You know, countless diligence, you know, we have no records. I mean, we have legal ways to recreate what happened to an apartment's rent over time. Sometimes it's historical rent ledgers. Sometimes it's hopefully some good some reliable rent registration records. If clients don't have records, then we have to go back and see if the contractor who did the work is available to write an affidavit, and we get it across the finish line. But it is unfortunate that we had a set of rules and then the goalposts changed, which is sort of the story of our lives here in multifamily.
Sure, Christina, just staying with you for a second. What are the specific proposed changes to the substantial rehabilitation rules that you're familiar with?
So one of the ones that I find, again, I hate to harp on this punitive nature, but it used to be that there was if a building was 80% vacant, it used to be that there was a presumption that the building was in such poor condition that it was in need of a substantial rehabilitation. You know, personally, I think, you know, if you have a building that's 100 years old, it needs new systems, whether there are tenants in there or there are not tenants in there. You know, these are, you know, as Chip has been highlighting, you know, if you don't follow Chip on Instagram, you really have to, because they're doing a tremendous job of highlighting what these vacant apartments look like once they are vacated after a 40-year tenancy. So there was a presumption that if the the building was 80% vacant, that it was in seriously deteriorated condition. Now they're taking away the presumption. So now more burdensome on the owner. You have to prove that your building was in substantial condition by getting an engineer's report, by getting a structural engineer's report. And again, just justifying your existence as a building owner who simply wants to put new electric, new boiler, new roof, new windows, create livable housing people feel good about coming home to. So, you know, it's hard to not see both of these code revisions as simply, you know, another hot poker in the side of owners. And it's just been uphill. That's one of the changes to the sub rehab, proposed changes to sub rehab.
Thank you, Christina. Jay, you know, we mentioned all the vacant apartments. One of our audience members wants to know kind of the breakdown, you know, of those, you know, by borough of where those units are and what people are doing, how you're advising owners, you know, to move forward with that. And if you could provide any insight there, would be great.
Yeah, thanks. So they're all over, but primarily they are in the Bronx, Queens, far northern Manhattan, north of the hundreds, and Brooklyn, non-gentrified, although I hate to use that word, areas of Brooklyn and parts of Queens. Very limited in Staten Island. So these are basically in very steady rent growth neighborhoods that haven't seen massive rent spikes, very steady, again, rent growth. Not a lot of institutional investment has come into these neighborhoods before. They are in buildings that definitely need work, where the rent rolls do not support the significant amount of investment needed into these properties. And I think, you know what, I must say, I'm just fascinated by this. I really appreciate you guys having this. I know Christina and I are painting this kind of doom and gloom picture of how difficult it is and all the problems of buying property in New York. But look, if you can make it here, and you know, I've heard somebody say this before, and I think it's all that. If you can make it here, you can make it anywhere. Like there is a reason why you invest in New York. There is a good reason to do it. There isn't any more land being built in this city. There's a finite amount of area. Property is very important, and housing is extremely important. There is no scenario where New York does not need to continue to invest and build new housing for this city to survive in the long term. There's 2.2 million apartment units on average, give or take a few hundred, and 5.5 million renters, and growing. So as long as that dynamic exists, New York real estate will always be a good investment. These turf battles, dealing with long-term rent stabilization and the investment in these properties that need significant investment, will continue to happen as long as there's this dichotomy between politics and good housing policy. But for every battle we lose, we make a few steps. And yes, we're in a bad period right now with the current elected class, but it's politics and life is a pendulum and it swings. And I really feel that we are on the cusp of making some significant improvements going back to a more rational housing policy system.
Couldn't agree more. You know, all my clients are providing workforce housing, which obviously, you know, we need to house New Yorkers, and this has always been the endeavor. You know, it's to provide new, good housing for people who feel good about where they live, and that's been the objective. I mean, it will always be, you know, the place to be, the place to buy. And I also, you know, just to echo what Jay said, there are a lot of reasons to be optimistic about what's to come.
Okay, and what's, you know, Jay, what's one specific thing each participant, each landlord on this call could do that could help with CHIP's efforts right now? And then,
Well,
and then I want to touch quickly back on the housing court case and,
yeah, well, vote first and foremost.
Yeah.
Vote,
Yeah.
even if you're registered otherwise, Democrat, Republican, or elsewhere, you need to vote, and never assume that one vote doesn't matter, because we've seen it too many times in elections. 2, email me, Christina, about how you can get involved more specifically with the efforts that we're undertaking. Look, the politics is very simple. It's an equation, just like in an investment. Are there more people against a proposal than there are for a proposal? And that's what politicians weigh. It's a very simple mathematic equation. So if they get the impression that there is an issue and there is enough kind of frustration on one side as there is on the other, and there will always be outnumbered by the number of renters to property owners or brokers even. But if we can balance the scales through social media and through email and through phone calls, and through the mechanisms of the 21st century, we can easily give the perception that there's equal frustration on both sides of an issue, and that puts us at the table. And once we're at the table, our arguments are sounder than the other sides. They make more sense, they provide better housing, and they provide better economic revenue to the city and state. So it's get involved, help us deliver that message on a daily basis. Continue to invest in New York and help us amplify the problems with the laws and proposals that are being out there.
Yeah, I would also say, shout out to Shaun Riney, who, when the CONH pilot program was being discussed in the city council, I'm fairly sure that was the hearing that Shaun actually went down to the city council to testify at. And I can't say it enough. You have to be involved. The key to policy change is the right relationships. So if you're an owner and you're not a member of CHIP, that needs to change today. Thankfully, my sister Andrea Smyth is running for New York State Senate as we speak. She is in the last 2 weeks of her campaign. And she, has been in Albany for 30 years and decided that it was time to become a public servant. And she will soon be our next New York State Senator. I'm not saying that we should have, however many people are on the call, you should run for public office, but your vote and your voice as multifamily owners really matters in policy changes. As much as you don't think it does, it absolutely does. And not about your bottom line. Don't talk about how, it's untenable to run the buildings. It really is about your endeavor to get more jobs with getting back some kind of apartment renovation workforce, right? Think about all the jobs we lost when I went away, and creating good, affordable, safe housing. And, I know that the owners on the call share that objective.
Yeah, well said, Christina, Jay. There's a lot more questions here, but we're running out of time. So I just want to wrap up and say thank you to everyone on the panel. Thank you for joining us. You can see our contact information. Feel free to reach out to us to set up phone calls or in-person meetings to talk about anything that we did not address. And again, thank you all for joining. Jay, Christina, Joe, Shaun. Looking forward to seeing you all soon. And thanks again.
Thanks so much to New York Multifamily.
Thank you, everybody.